Hi, Glenn. How are you?
Hey there, Ross Levine. I'm all right. How you doing?
Everything is great.
That's good. I have in my hand your paper. Oh, we should say that I'm Glenn Loury, professor of economics at Brown University.
And I am Ross Levine, also professor of economics at Brown University.
Okay, so people should not hold it against us either that we're economists or that we're both at the same institution. Because our agenda is to try to, it's at least my agenda is to try to learn something about financial crisis and the roots thereof. And we're continuing a conversation that we had previously a few weeks ago on this very subject.
Yes.
And you are, fortunately, an expert on this subject, which is good because we need expertise. So I have in my hand your paper, An Autopsy of the U.S. Financial System, in which I assume a link can be posted on the website of Blogging Heads so people can get at your paper.
That would be great. Always willing to advertise my writings.
So you're doing an autopsy. The corpse is laying there cold on the table.
Yes.
And the issue is forensic, right? I mean, figuring out what happened.
Correct. So I figured that it was valuable to figure out what happened, and then that becomes a natural first step toward figuring out what to do so that it doesn't happen again.
So the dead body could have been an accident.
Yes. And it could have been suicide. So what I had in mind, using a little bit of colorful language, is that with an accident, I'm kind of playing on what Alan Greenspan called a once-in-100-years flood, that there were massive capital inflows from the rest of the world, especially China, arguably because there was this glut of savings. All of this capital that was rushing into the U.S. needed to find some place to fall. Much of it ended up in mortgages, and there were a reduction in lending standards. There were innovations in order to keep the flow of international savings flowing to mortgages, and eventually things blew up. And that's sort of the accident component.
Okay, so one explanation is what happened to us was just bad luck. Whole lot of things conspired, and who would have thunk it? Who could have seen it? And oh my God.
Exactly, and you hear that type of language from many of the officials that have gone in front of Congress to testify about the causes of the crisis.
Yeah.
They're typically sorry that this occurred, that this was an extraordinary event, and they wish that they could have seen this happening. So they talk about this very much as if it were an accident.
Yeah, I gather you're going to be skeptical of that claim.
I think that there is an accident component. I think that there were massive international capital flows. But I don't think that that's the only part of the story or the major part of the story. Just to finish the subtitle of the paper, there's also an element in which the crisis is described as suicide. And again, I use that to play along with the language of an accident, a suicide, or then I ultimately will call it negligent homicide. But the suicide component is that the financial institutions had to make these crazy investments because they could get profits in the short run, even though it destabilized the system in the long run. And so there's a notion that the financial system were a bunch of lemmings kind of running off of a cliff, and that also helps explain the crisis, that this was just some irrational activity, a cascade of events by the private sector participants that, again, just happened to happen to the policymakers that were sitting in Washington and in regulatory agencies actually around the world.
Okay, so option number two, if it's not an accident, just, like a hurricane hits you, what can you do? Maybe it's we went crazy, some kind of collective psychosis or madness, and we ran off the edge of the cliff not knowing what we were doing.
Exactly. So this is sort of the irrational exuberance, the way Greenspan described it. And actually that was more with the dot-com bubble, but it could be applied to this as well.
Okay, so that's option number two.
Yes.
And I gather you're going to dismiss that also.
That's true. So my own view is that a large component of this was negligent homicide. And the reason why I call it negligent homicide is that I think that policymakers created an environment in which it was they created a very reckless environment in which they increased the probability that there would be a massive collapse of the financial system. So to give an analogy, if you kind of have a house and you're lucky enough to have a swimming pool, which I don't have, but perhaps one is lucky enough to have a swimming pool, and you have a bunch of teenagers who can swim, you might leave all the doors open, and you have a sign that says, warning, swimming pool. Then there might be an innovation, a change, and this innovation or change might come in the form of a toddler. And so if this toddler is running around and happens to fall into the pool and drown, we might call that an accident. Nobody pushed the toddler into the pool. We might call that suicide. The toddler shouldn't have run around like a maniac. And
I get it, but more likely we were negligent because we should have seen that a sign up there was not enough, given that there was a toddler in the house.
Exactly. And so my sort of post-mortem, if you will, of the financial crisis is that I want to look at the period between, say, about 1996 to 2006. So I want to choose a period before policymakers moved into crisis mode. I want to examine a long period over which policymakers had a chance to adjust their policies as new information became available. I don't want to expect that the policymakers are all seeing or all knowing. I want to give them a nice long period of time, 10 years, say, in which they can adjust their policies if they see things going awry, and before the world starts to end. And so that's sort of the focus of the paper. It's this long period.
So, no, I think you're very effective in this paper in making your case, and I see the point of focusing on business as usual. And then there's a lot of detail here. And I don't know if we can go into all of it, but I think we should go into some of it, where you trace through the evolution of regulatory policy, even as there's financial innovation and new developments, new instruments, and new dynamics are being introduced into the marketplace. By looking, as you say, at this period of sort of normal operating procedure, the evidence that the people with their hands on the switches were negligent begins to accumulate. Mm-hmm. So why? I mean, we could take one of these areas. I found the discussion of, for example, the evolution of the credit rating agencies.
Correct.
And of the complex set of business relationships that they had with their customers/clients to be quite interesting. And I found also your discussion both of the introduction, the change in regime that occurred, what was it, in 1975 with the designation of certain statistical organizations as being official rating agencies, and then with the evolving reliance upon their assessment of the credit worthiness of particular financial entities, the evolving reliance on their assessments of many other financial institutions, and how that affected their let me not tell the story since you're the expert. But there are all these details that I really think that are not about the crisis. They're about how we regulate financial institutions in this country, at least how we have done in recent history.
Correct. Once you get into the details of this, you start to become afraid, very afraid.
But why don't you give us some idea of what this is about, say, in the case of the credit rating agency?
Sure. So one might think that given the central role of credit rating agencies in the allocation of credit across the globe, that they earned this central pivotal role in terms of who gets access to money and at what cost, that they earned this role by being very good at evaluating credit worthiness.
Yeah, you would take that.
And if you were to have such a view, you would be wrong. Okay, so up until the mid-1970s or so, credit rating agencies were a very sleepy, moribund institution. The academic studies that were done suggested that the credit rating agencies lagged behind the market by 18 months in terms of providing a prediction about how a firm was going to do in terms of its ability to pay its debts.
Can we name names here? Who are the credit rating agencies?
So the big credit rating agencies now are Moody's and S&P. And so, and these are still, in the mid-1970s, they are designated by the Securities and Exchange Commission, the SEC, as special. SEC, we might call it approved, national statistical rating organizations.
Yeah.
And they get this designation because the SEC doesn't want to, as a public entity, doesn't want to be the only entity setting risk assessments so that it can make sure that the investment banks that the SEC is regulating have enough capital relative to their risk. So they say, you guys, you credit rating agencies, we're going to rely on your ratings to set our capital standards for the brokerage firm.
So this is like contracting out or privatizing the function of assessing the riskiness of securities that the SEC needs to assess in order to carry out its oversight functions.
Exactly. In order to make sure that the investment banks have enough put aside for a rainy day. And then what happens, and this is the part that I was unaware of and found very interesting when I started to do the autopsy, is that other regulatory agencies in the U.S. and around the world followed the lead. So when then the bank regulators, the Federal Reserve in particular, started using the ratings in order to make set its capital requirements for banks.
I see. With these designated agencies already being there.
Exactly.
And with the SEC already very publicly relying on them.
Exactly.
Now a bank regulator, this is another branch of the government altogether and another segment of the financial services industry, has turned to these rating agencies to provide them with the assessment of the securities that the banks that they're regulating, the riskiness of those securities.
Exactly. And then the insurance companies. And then foreign bank regulators.
Now, wait a minute. It's getting to be pretty good to be a rating agency if all these people need you to rate their securities.
Absolutely. It's very, very good. So what happens now if you're a rating agency and essentially all of the purchasers of securities, okay, when they go to their regulators, bank regulator, insurance regulator, securities regulator, when the ultimate purchasers of securities go to their regulators, they need to show their regulators that the securities that they're buying have a rating from one of these special approved rating agencies. So this creates an enormous market for the services provided by the rating agency. And so it was good to be a rating agency, as you put it. And so their market expanded enormously, and they became very profitable.
Now, was there competition between the rating agencies for customers, or was there any possibility for new rating agencies to enter this lucrative trade?
For about 25 years, there was very little entry allowed into this special designation of SEC-approved credit rating agencies. Fitch enters the market, but it's basically a duopoly. And then later, around the mid-1990s, 2000, a few more rating agencies are allowed to enter. But again, by this point, these two rating agencies dominate. And they control combined about 90% of the market.
You mentioned a number on Moody's profit margin that was mind-boggling, like 40%, 50%?
Correct. So in the 2000s, Moody's, S&P, they have profit margins of about 40 to 50%, much, much more profitable than, say, Google or Microsoft or, Intel, for example.
But now, okay, were they doing their jobs well? I gather you think not.
Not too well. So they always had this conflict of interest, because the other thing that happened once the SEC gave them this special designation is that there was a change in how these rating agencies funded the services they provided. So originally what they did is that if Glenn or Ross wanted information about the creditworthiness of a security, we would pay Moody's, for example, for their assessment of that security in the company.
So we would be like subscribers to their information service.
Exactly. And so they would provide a service to us, and the service that they would provide to us is their assessment of Exxon security, a security issued by Exxon. What happened when the SEC changed the rules of the game in the mid-1970s and basically said that these rating agencies, their ratings are going to be used to define the capital standards of the investment banks. And then this was followed by the rest of the regulatory agencies, banks, insurance companies, government municipalities, school districts around the world.
Yeah.
What happened in that case is then the rating agencies could charge Exxon. And so basically, if Exxon wanted to issue a security and it wanted to have a broad range of people that could potentially buy the security, Exxon needed to have its securities rated. And so basically what happened is that the rating agencies went and they said, Exxon, you pay us. So hence there was this natural conflict of interest because Exxon now was paying Moody's to rate Exxon's securities.
No, I see this. This is like, so when we need a handyman at the house, we go to Angie's List, okay? And we look to see basically the ratings of different carpenters or, handymen that might come to the house to fix something.
Right.
And they get rated. They get rated, thankfully, by other customers.
Correct.
Okay? But what you're describing would be like all the handymen had a deal with Angie's List where they paid Angie's List in order to post a rating on them.
Yes.
And then Angie's List was turning around and presumably making money by running a website where it could sell advertising where I would go to look to see what their ratings were.
Correct.
But the Angie's List would have an interest in encouraging people, that is handymen, to list with them by promising to give them high ratings.
Exactly.
And you're saying that's what financial instrument rating agencies were doing?
Correct. Exactly. That's what they've been doing.
But I mean, are you saying that they were over assessing the quality of the securities intentionally as a kind of understanding between the company about to issue the security and the agency about to rate it, that we're going to rate this better than it really is because we know that that's good for you, and since we're doing you this favor, you're going to compensate us with future business?
Not initially. So I think that this conflict existed for, from the time that they started charging the issuers of securities for the ratings. But what the rating agencies argued, and I think it was reasonably accurate, was that the rating agencies would argue is, look, if we sell an inflated rating on a security to one firm, what's going to happen is that the purchasers of securities, and all of the securities, are going to start to doubt and question our ability to assess risk. And so we, the particular rating agency, our reputation will diminish and their business will start to go to the other rating agencies.
The theory is they'll do a good job on the ratings because they'll lose their credibility in the marketplace if they don't.
Exactly. And so the notion was that the rating agencies wouldn't sell their souls for $1 million because by keeping their reputations, there were billions to be made farther down the road.
Yeah.
And so this worked, arguably, until the emergence, the innovation of structured products. So when I gave the analogy about the innovation of a toddler, the reason why the analogy is hopefully helpful is that the rules that worked under one regime, a regime in which you had only teenagers in the house that could swim well, will not necessarily work in this new regime. And the new regime now is structured products.
Tell us what structured products are.
So what happened with structured products are where you have the emergence of mortgage-backed securities. So mortgage-backed securities are a very sound innovation. And so if I'm a little bank and I'm making a bunch of loans to people in my neighborhood for them to purchase homes, and I use up all of the deposits in terms of making loans, but there are other good people in my community that need access to mortgages. What I could do is bundle up the mortgages that I have made, sell them in the marketplace, and then I'll have more money to make loans to worthy people in my neighborhood. That bundle of securities that gets sold into the market, okay, it's oftentimes chopped up into various pieces, and each of those pieces, before they're sold to potential purchasers, and this could be pension funds, this could be mutual funds, this could be purchased by banks, it could be purchased by insurance companies, it could be purchased by school districts, it could be purchased by Brown's Endowment, it could be purchased by many entities. Each of those has to be rated.
Okay, so let me just make sure.
Sure.
So what I've got now is 100 or 1,000 or something like that individual mortgages.
Correct.
Or maybe I've got fractions of mortgages, I don't know, that are combined together into a new asset, which is then going to be sold, and the quality of which has to be rated.
Exactly.
Okay, so this new instrument, this structured product, this bundling together of individual mortgages, that's the toddler who's walked near the pool, because this is a thing different from the other kinds of financial instruments that rating agencies have been dealing with.
Exactly. And so the change here is twofold. One is that it's new and complex, and the other is that this is an enormous market.
Yeah.
So this is a multi-trillion-dollar addition to what rating agencies can rate. So this is not a gold mine. I guess it's a diamond mine. I mean, they hit the jackpot.
Can I just observe here, as a non-financial economist, but an economist, if a new market is created in a previously non-existent financial instrument that attracts trillions of dollars of investment,
yeah,
it must be doing something good. I mean, there must be some surplus, some productivity enhancement that has been occasioned by the introduction of this new product, if it has attracted so much money. Is that not correct?
So I think that these innovations, there was a good element, and then ultimately there were distortions that I think turned it in a much more pernicious direction. So let me describe the good element, because I think it's easy for people to talk about toxic assets and these crazy securities. But at a very basic level, this wasn't crazy. So there are two elements to this. So one element is that let's say we have a bundle of mortgages from the different departments across Brown. Of people, the professors have bought homes, and we have all of these different mortgages.
Yeah.
Okay, so we could, and this could be done by the Ruth Simmons Bank of Providence, who's the president of Brown University.
Our president.
And so she then has all of these assets, and she's done as good a job as possible at assessing the risks. And now there are new faculty coming in. Brown is expanding, and she needs additional resources to make new loans. And so she could take these mortgages, bundle them up, and sell them through Goldman Sachs to other investors. And then Ruth would then have these new resources in which to invest wisely in the growth of Brown.
Okay, that's what you were saying before, and that's the
Correct.
benefit.
So that's one benefit. Then there's sort of a second benefit, and that's sort of where Goldman Sachs comes in to a little bit greater degree. Now we have all of these mortgages, these promises to pay from all of the different faculty members across Brown. Now, you and I might potentially buy part of this new security that has been sold to Goldman Sachs by Ruth.
This new security consisting of the bundled mortgages of the Brown faculty.
Exactly.
Yeah.
Now, the more that we're willing to pay for this security, the more that Ruth gets, and the better investment she could make in improving Brown. Okay? Or in kind of a broader context, the better this would be for the housing market in general.
Okay.
Now,
you want a high price on this security.
Correct. Now, you and I might have different tastes. So, for example, if we each buy a share of this bundle, that means if there's a reduction, if there are any defaults, you and I share in that equally.
Yes.
But you and I might have very different tastes for risk.
All right.
So let's say you like a lot of return and you're willing to have a little bit more risk.
Right.
And let's say I'm really risk averse and I don't want any risk.
Got it.
Then if you sell you a share and me a share, neither one of us is particularly enthusiastic. But if Goldman Sachs comes along and does a little bit of financial engineering, what it can do is it could say, why don't we do the following? This resources that flow into the bundle, why don't we first use those resources to pay off a set of very safe securities? Then after the safe securities are paid off in full, we'll use them to pay off the more risky securities. Then someone like me who's very risk averse, I can pay a high price for the risky securities, for the safe securities, meaning that I'll get a fairly low rate of return but very safe, and you'll pay less for the riskier securities. But what this does is this gives you a security that you are enthusiastic about. It gives me a security that I'm enthusiastic about. And if Goldman Sachs does this engineering just right, it will increase the total demand of Glenn and Ross for this bundle, which ultimately means that Ruth has more resources to build Brown. Or if we get away from the analogy with Ruth and Brown, it means that the mortgage companies can either charge a lower interest rate to the people purchasing homes or have more resources available to buy homes.
Okay,
so
that's complicated, Ross. I think
okay.
we need to review it, but let me try. Okay.
Okay.
So what I hear you saying is we've got this structured asset security, which is the bundling together of a large number of loans.
Yep.
Now, the people who want to buy securities like this are not all the same. They have different ideas about how much risk they want to take. If you just cut this thing into an equal number, large number of smaller pieces, they'd all look alike, and they might not be what anybody wants.
Correct.
Instead, what you can do is you can take different parts of this bundle, and you can, in effect, sell to different buyers who are only getting a piece of the total package loan, different components of the package, to suit their individual preferences.
Yep.
This is what's called financial engineering, and evidently it's a complicated enterprise.
Correct. Or if you wanted to make it simpler in terms of the pizza, if you and I go out for pizza and I like mushrooms and you like green pepper, sprinkling the entire pizza with a mixture of mushrooms and green pepper doesn't make either of us particularly happy.
Yeah, I get it.
And so if we go half and half, then we each have a greater demand for the pizza, and we can pay more.
Okay, now
for
this
the
interacts with your point about rating agencies, because the agencies now have to rate these much more complex, differently structured sub-pieces of the overall bundle.
Exactly. And so each of those things now has to be rated, and this creates a bigger market for their services. Now, that in and of itself, if they didn't have any conflicts of interest, this could work quite well. But here's where sort of a lot of the incentive problems come in. Because what Goldman Sachs wants is it wants as high a rating as possible, because then people will want to buy the security with more enthusiasm.
Sure.
So what the investment banks did is they went to the rating agencies and they basically said, look, why don't you bundle the securities? Why don't you make the special securities that Glenn wants and that Ross wants?
Oh, I get it. Okay, I see.
And so we'll pay you, the rating agencies, essentially as a consulting advice on how to bundle the things. And then,
since you know how you're going to rate them, you can tell us how to package them so that you'll be able to rate them highly.
Correct. And then we'll pay you again
to rate them.
So
they're consulting on the structuring of the packages, and then they're providing a rating of those packages. So how are they going to not give it a high rating, since it will have been the product of their own consultancy?
Right, and therein lies the problem. And so then kind of going back to the phrase about they wouldn't sell their souls for $1 million because it was a few billion down the road.
Yeah.
Now it's sort of changed with a huge market and the additional compensation coming from consulting. The issue is, okay, we'll sell our soul for tens of billions of dollars because the loss down the road is just not going to be that great. And so what you observe is, one, the credit rating agencies, they really don't have the models, the data, the sophistication to rate these new complicated securities, but they do it anyway, and they know it. All the internal emails that we have suggest that the credit rating agencies know that they don't know what they're doing, but they do know that they have to give it a high rating to get it out the door, because stopping this flow of securities means a loss of an enormous amount of profits.
Now, I'm wondering where the regulators are in all of this. That you make the point in the paper that this situation of potential conflict of interest that rating agencies might face in their dealings with the issuers of securities is not unlike the previous situation of conflict of interest between certified public accounting firms and corporations whose financial statements they would have to certify, but who were also hiring them to consult on the preparation of those financial statements.
Exactly. So this should not have looked unfamiliar to the SEC. But nonetheless, nothing was done about this. Indeed, there were conferences and articles published very early on in the structuring process. I'm talking about the late 1990s. There were already legal scholars and other academics holding conferences talking about how the emergence of structured finance was going to dramatically intensify the conflicts of interest within rating agencies. And nothing was done. And by the way, nothing has been done.
So, negligent homicide.
So that's why it's very difficult to look at the story of the credit rating agencies and view what happened as simply an accident.
Is it the SEC? Does the buck stop there? Are there committees of Congress that have oversight responsibility that ought to have been active? Where's the Fed in this story? I assume that the academic finance community must have had some commentary or critical analysis of the situation. How could such a thing just evolve into a really big problem without there having been public argument about it?
So I think that here some responsibility, maybe a lot of responsibility, falls on the SEC. And they are nominally they are nominally independent, and they nominally stand over the credit rating agencies.
Oh, I see. Mm-hmm.
But there's also an issue in that Congress passed laws that limited the ability of the SEC to get involved in the credit rating assessments about how credit rating agencies did their assessments of risk.
Is that because the agencies thought that their methods were proprietary and shouldn't have been subject to outside scrutiny?
I'm not sure. I think part of it also has to do with a genuine concern that you would not necessarily want a public entity getting too involved in the rating of private securities, because then you could have government influence over the flow of credit.
Yeah.
But that fear, while legitimate, does not necessarily mean that you would not want to have regulatory oversight over the overall methods and techniques that were being used in order to evaluate risk, one. And two, the growing conflicts of interest, especially in light, as you mentioned, of what happened with the accounting firms, suggests that the SEC should have been screaming bloody murder to Congress about this as a problem. And there was really very little discussion by the regulatory agencies about this.
Meanwhile, huge profits are being made at the regulatory agencies, not to mention the profits that are being made by the various financial institutions who are purchasing their services.
Correct. And my guess is that some of those profits also made their way into lobbying Congress about not changing the rules of the game.
Which kind of goes without saying. That's perfect. You have this three-word sentence in that you start your conclusion with: finance is powerful. And I was struck by that because not only do we have a financial crisis which could precipitate or exacerbate a recession, but we also have billions, hundreds of billions, trillions of dollars flowing either well or not so well to productive uses that people who seek credit would like to pursue. And can you talk a little bit then about sort of the real consequences of all of this? Where this hits the ground on Main Street.
Yeah. So as you know, my main interest in finance is not with the mechanical details of mortgage-backed securities, although there's something entertaining about that. My main interest is exactly as you put it, that the flow of credit defines or influences what types of opportunities people have. And so if the financial sector works well, credit tends to go to those with the best ideas, the most energy. And if the financial system does not work very well, it can either go to those in many countries where there are very tight political connections, or, as what happened in this crisis, I think it's more accurate to say that the distortion, for example, with the credit rating agencies, the conflicts of interest, the distortion of the flow of credit sent it in a very inefficient direction, which meant that other people with good ideas did not have access to the savings to pursue whatever dreams that they wanted. And so this.
What does that mean concretely? I mean, are you saying there are shopping centers that shouldn't have been built, that there are houses that are sitting empty now, that that money that bought them could have gone to helping somebody start a business? How has the financial crisis distorted the allocation of credit? Who's gotten it who didn't need it? Who hasn't gotten it who might have been able to use it?
So I think that there's no question that an enormous amount of credit was funneled into the housing market, and it shouldn't have been funneled there. And if it doesn't go into the housing market, that's going to mean it's going to be made available to people who want to start a new business and pursue some other dream that they want.
Okay, so overinvestment in housing.
Overinvestment in housing, or put differently, underinvestment in other more productive enterprises. And now the consequences of that are that taxpayers are going to be paying over a long period of time a much higher tax rate, because many institutions that made a lot of money by investing in securities related to housing failed. And so there was a large reallocation of society's resources from the many with not too much to the few that already had a lot in the name of bailing out the financial system. And so what this means is that there's less available to invest in housing, there's less available to invest in infrastructure, and this means that this crisis will curtail the opportunities for people to go to school, the quality of the schools that they go to, and then the credit available to them to pursue other types of activities.
All of that stuff is got to be very difficult to actually measure.
It's very difficult to
I would guess, to actually be able to quantify what the magnitude of the foregone, benefits because of misallocation of credit. Be hard to put a number on it.
It is hard to put a number on it. And I think when people do studies, there are very aggregate, or to use a bad word for you, the sort of, kind of the very macro growth type evaluations suggest that finance has a material influence on economic growth. I think that a more immediate focus on the current crisis, I think we're talking of trillions of dollars of foregone resources. The Fed, for example, just spent $1.2 trillion on lousy assets from banks, even though it paid market value to the banks in order to save the banks. Fannie and Freddie Mae are also being used to buy up bad assets from financial institutions in order to save private financial institutions.
Yeah.
And this is a very costly undertaking. And if we spend trillions of dollars on this, then we're not spending trillions of dollars on other investments to promote the welfare of our citizens. It is hard to quantify, but we are talking about big numbers.
Well, so we had another thing to talk about, which was related. We had two other things to talk about. One of them was the pending legislation in Congress about financial reform. Is it as big a deal as the politicians nowadays are making it out to be? Do you think it's on the right track? And then the other was a little bit more afield from finance, but was to raise a question about, what this says about our values and the kind of politics in our society more generally. And I hope we can get to both of them, although we only have maybe 10, 15 minutes left. So,
okay, you're the boss, so you just run it however you want.
Okay, everybody can read the newspaper about what Congress is doing on finance. Do you have something important to say about that?
The thing I would say important about that is that if you look at the Senate bill, which most people probably won't, it runs to 1,000.
But it's online. It's easy to get.
It is easy to get. It runs to 1,000 pages. The House bill is about the same. It's very complicated. My guess is that what most people want to know is this going to make my savings safer and my future more prosperous? And my argument, my evaluation, the answer is not much.
Yeah.
I don't think that the proposals in general are bad.
Yeah.
These are not going to create huge problems. I'm not against the Senate plan. I just don't think that they get at the core problems within financial institutions to the degree that I hope ongoing reforms will ultimately get to. So what is the core weakness in my own view? The core weakness in my own view is that banks, financial institutions are run by the executives, that the executives really are not controlled by the board of directors, since it's the executives themselves that tend to choose the members of the board of directors.
This is the corporate governance problem.
This is the corporate governance problem, that shareholders ultimately have fairly little influence over major financial institutions in which, by regulation, there's not a large shareholder. There's only a set of diffuse shareholders. The other type of private sector entity that might induce the executive to behave prudently are creditors, people that buy, or institutions that buy debts from the banks, that lend money to the banks. The depositors are not going to put pressure on the executives because they're insured by the government. The bondholders of the banks, the entities that bought bonds from the banks, are going to also be very limited in the pressure that they put on the executives, because when push came to shove in the current crisis, the government either directly bailed out the bondholders by insuring those bonds, or indirectly bailed out other debt holders in the bank by buying the bank's assets at market value and subsidizing the bank through other mechanisms. So again, most of the creditors of the bank were also made whole by taxpayers, reducing their incentives to put pressure on the executives.
Okay, so we got a governance problem because the bank shareholders are or the institution shareholders are shut out, and the creditors who have a stake don't have any way of really getting a say in what's going on at the institution.
Exactly, and so I think that there are a variety of proposals out there to strengthen the ability of shareholders and to...
But you can just do that for financial entities, could you? If there were going to be legislation about corporate governance, might it not also have implications for other kinds of corporations?
I think that there is a great need to have much better corporate governance
across the board.
Across the board. But given the nature of the current crisis, finance is not a bad place to start. It's also true that in banks, the additional problem compared to a corporation, a non-financial corporation, is that the creditors in a non-financial corporation tend to have a more powerful influence over the firm than in a bank, because the creditors in the bank, when push came to shove, were bailed out by the government. But your point, yes, this could be done across the board to improve.
Now, one thing I'm wondering is whether the transparency problem that you've called attention to in the derivatives market is at all being dealt with in this proposed legislation. You have said, we've got all these credit default swap type contracts out there where counterparties are promising to come across with cash if somebody defaults somewhere.
Yep.
We don't know who they are and whether or not they're able to man up when the time comes.
Yep.
And the regulators don't know who they are either, and therefore can't properly assess the circumstances. Now, is anybody proposing to do anything about that?
Yes. In the Senate bill, we have to see what happens as this goes into committee and they reconcile the House and the Senate bills. But as part of the Senate bill right now, there are efforts to make the derivatives market, the over-the-counter derivatives market, more transparent so that it goes through a clearinghouse, which would make it easier to identify the counterparties to all these contracts. And so this is difficult because there are a variety of derivatives in the over-the-counter derivatives market in which you have custom-designed contracts.
Yeah.
So it could be along the lines of, Glenn buys a security that, pays off if, the Celtics, go to the championship because you're a Celtics fan and this would be costly to you, so you want some compensation.
Right.
So this would be a very specific type of contract that would not be broadly traded. So there's a role for those types of contracts to be traded in kind of a customized market, but there are many other types of contracts that could be exchanged in a more standardized form in a clearinghouse. And I think that part of the push in the Senate bill is to try to do that as much as possible. Okay. Now, the credit rating agencies are a different issue. Though many of these securities have to be rated, but that was taken out of the proposed legislation. As I understand it now, there are no real efforts to make the credit rating agencies more accountable.
This conflict of interest problem that you talked about,
correct,
will then still exist.
Correct.
I see. Okay, so then let's move to the last topic.
Okay.
So there's a scholar at the University of California, Berkeley's law school called Jonathan Simon.
Yes.
And Jonathan has written a paper somewhat tongue-in-cheek, somewhat serious, in which he draws analogies between the financial crisis and the toxic assets that we're all familiar with, on the one hand, and the incarceration crisis. How did I get there? Well, that's what I work on.
Yeah.
The incarceration crisis and the toxic assets, the toxic human assets that are that one encounters there. And you read that paper. I asked you to read it for this conversation because
yep.
I thought your reaction would be interesting
yep.
to this law professor who worries about crime control policy and imprisonment, but who has borrowed some of the concepts from finance. And you, this finance professor who works with those finance concepts every day, but also I think cares really very deeply about social issues and about inequality. So what do you have to say about this? This kind of whimsical, speculative flight of fancy of Professor Simon.
So I was enthralled by your presentation, a series of presentations you've given about mass incarceration in the United States. So I enjoyed reading the article, and it related stuff to finance.
Great. So
from my perspective, there were at least two interesting components that come to mind right now. So one is that there's a similarity that as a society, two major factors are investment in human capital and investment in physical capital.
Okay.
And so we can have distortions, as we've had in the financial sector, in which there's a misallocation of physical capital, which hurts society as a whole. And I think what I got out partially from his article is that there can be a set of distortions in policies, in this case perhaps criminal policies, that can create very costly distortions that can hurt the development of human capital and therefore permanently, or at least in an enduring fashion, hurt the opportunities that people, individuals, and whole communities have for economic success. And so for me, it was like from the public policy perspective, we're messing up in terms of where society makes its investments, both in terms of people and in terms of resources. Do we want to invest? Do we want to kind of create rules of the game that enrich Moody's for exaggerating the ratings on individual securities? Do we want a set of policies that are going to put massive amounts of people, of particular groups, in jail, and therefore prohibit them and their communities from realizing the potential? Or, in both cases, are there better ways to use society's resources? And so I was kind of, I found that interesting. And I'm kind of blabbing, but the second thing had to do with the crisis.
Yeah.
When push came to shove in the crisis, society, and I'm talking about a Republican administration
and a
Democratic administration, it didn't really matter. There was nothing partisan. There was, everybody shouted, but basically whether it was the Bush administration or whether it was the Obama administration, in the end, we came up with massive amounts of money to bail out the bankers. That's kind of a broad term for financiers, in order to save a collective group of individuals that we thought would have big implications for society as a whole. And yet, even though we're talking about millions of people that are being put in jail at an unprecedented rate, we are not willing to invest anywhere near the amount of money in order to improve the lives of people in particular communities. And I know that analogies break down, but there seems something very wrong about the way we're spending money.
So let me pursue both of these points. One point has to do with just the pure kind of economics of investment. You can invest in financial and physical capital. Yep. Helping companies be able to get up and running, to build plant and equipment, to invest in their inventories, to pay their payrolls in advance of receiving income from what they're going to sell, to do business. You can invest in that. You can invest in people, human capital, develop their capacities, improve their health, increase their cognitive skills, get them training so that they can do useful work and have fulfilling lives. And maybe we're not getting it right, the relative emphasis that we're putting on these two crudely distinguished arenas in which social investment can take place. So that's one point.
Correct. On that point, I would also add just that within finance, even if there's going to be an investment in companies, there can be policy distortions that lead you to invest in stupid companies and some that lead you to invest in good companies.
Yeah.
Similarly, with the human capital element, we can invest a lot in prisons and law enforcement, or depending upon the combination, we could invest a lot in communities and schools and people. And we might have greater success in terms of promoting human capital by investing more in the schools and the communities.
Okay.
That's the only.
So where do we invest? That's one point. But there was a second point, and that had to do with what do we feel a sense of crisis about that causes
Correct.
us to
point.
act. And we will bail out General Motors. The contemplation that they would go under is more than we can bear. But no one will talk about bailing out the city of Detroit, even though it can become, I'm talking about the urban area in which, I don't know how many people live there now. The population has been falling for 3 decades, I reckon. But probably goodly more than 1 million people are living there. And there's a urban implosion in terms of many measures of the quality of life in Detroit, but there's no mobilization to bail out Detroit. Is that the kind of thing that you're talking about?
That is the type of thing I'm talking about. Absolutely. Why are we not... When I saw your statistics about mass incarceration, I had an emotional response. I didn't know that this was going on, so one, I was a little bit annoyed at myself for being ignorant, but what's wrong with us? How can it be that we can afford to bail out the very people that caused this crisis and yet be unwilling to at least try to invest in programs that would reduce this type of mass incarceration and instead help the lives and expand the opportunities of many individuals? There's something very upsetting about the response of the collective. And that, again, the issue here is not a left or a right, because we had a collective response to the crisis, and I'm not sure why we couldn't have a collective response to lack of opportunities in some communities.
Let me venture an answer.
Okay.
The answer would be that the president can say of Lloyd Blankfein and others, I don't mean anything against Mr. Blankfein specifically, they're savvy businessmen. Mm-hmm. Even if they're sitting in front of him in a White House meeting or in front of the congressional committee, mumbling about what they did or didn't do that might have precipitated a crisis, but perhaps not taking responsibility for it. But they're still savvy businessmen. In other words, they have honor. They have a respected standing. What they do is valorized. It's elevated and put up on some pedestal. What fraction of the graduating class at Princeton or a Brown are applying for jobs in the financial services industry? Do you have any idea?
I'm not sure, but very large.
Yeah, I wouldn't want to venture a number because I don't have any data either. But if you told me it was 30%, I wouldn't be surprised.
Correct.
So this is an honorable pursuit, which has a kind of iconic place within America's rugged capitalists, et cetera. I won't go into the rhetoric. Whereas, if I'm confronted with a 22-year-old who's a stick-up man and he's hijacking a car or robbing people, I've got a thug. And I'm not trying to be sarcastic here. I'm saying the person is not an honored person. They're a dangerous person. They need to be dealt with. So to have an idea that I'm going to invest in thugs is going to be a difficult sell. But to have an idea that I've got systemic risk in the financial sector and I've got to step in order to, and these are, as you say, the accident narrative actually has legs, doesn't it? I mean, these are people who have so far pretty much avoided having, public, disrepute fall on them. But that's where I would look for an answer, that we don't think in the same way about the worthiness or the humanity, really, yes, of the people who are involved in these very different arenas of American life.
Yeah, no, I agree, and there's a cynical part of me that would also note that I think on this particular financial bill alone, the financial services industry has spent something like $600 million on lobbying, and my guess is that poor communities that are looking to build better schools have a much more difficult time focusing that much financial energy to support their views.
Yeah, there can be no doubt of that.
So,
okay, well, I guess we're at the end of a conversation, Ross. Thanks very much for doing it.
Always great to talk with you, Glenn.
Yep, I'll see you soon.
Great.
Bye.
Bye-bye.